Right now, the financial news cycle is absolutely out of control. From sudden Supreme Court tariff reversals throwing markets into a frenzy to heavily hyped retail IPOs dominating social media, it really feels like we're witnessing the financialization of absolutely everything. So let's dive straight into this explainer. Today, we're applying a healthy dose of professional skepticism. We're going to look past the influencer hype, rely on credential-backed analysis, and figure out what is actually happening with your money.
Between prediction markets letting you bet on literally anything under the sun, meme stocks making a comeback, and these massive tech IPOs, we have to ask a pretty serious question. Has investing simply become a giant casino? I mean, it's incredibly easy to get swept up in the fear of missing out when you constantly see people flashing huge returns online. But here's a staggering statistic to ground us back in reality. 84% of Polymarket users actually lose their money. And that right there sets the stage for our data-driven reality check today. We're going to strip away the noise and look at the hard numbers behind today's biggest financial headlines. Here's our roadmap for today. We'll be covering macro shocks, sovereign bets, the private credit squeeze, the SpaceX IPO, Gamifying finance, and wrapping up with retail takeaways.
Starting off with Section 1, Macro Shocks and Tariff Reversals.
The geopolitical landscape shifts incredibly fast. We just saw the Supreme Court rule that the 1977 IEPA law actually doesn't authorize the president to impose tariffs, totally striking down those broad levies. Now, the hype online immediately said the trade war was over, but the reality, well, it's a bit more complicated. Almost overnight, we saw a pivot to a brand new set of temporary 10% tariffs under a completely different trade act.
When you look at the hard data, economists are estimating that the expected drop in the effective tariff rate, falling from nearly 17% down to about 9.1%, will literally cut tariff-related inflation in half, which is absolutely fantastic news for consumers. However, on the corporate side of things, reclaiming the estimated $75 billion in previously collected tariffs is going to be an absolute legal nightmare. We're talking about companies being tied up in court for years trying to get that money back.
Moving to Section 2, Canada's billion-dollar bets.
So let's look at Canada's proposed Canada Strong Fund. The marketing pitch for this retail-accessible sovereign wealth fund sounds like a total slam dunk, right? The idea is to let everyday citizens invest alongside the government in these massive nation-building infrastructure projects. But the financial reality is kind of grim. Canada doesn't currently have a budget surplus, which means they're essentially borrowing money to kickstart this fund. Plus, for retail investors, this carries massive illiquidity risks. Infrastructure projects are not stocks you can just sell in a few seconds on an app. Everyday investors could easily have their money locked up for a decade.
And staying totally neutral here to just look at the raw fiscal math behind the Alberta independence pitch, we uncover some pretty severe hidden costs that definitely aren't making it onto the political bumper stickers. For instance, becoming a landlocked independent nation means instantly losing the Canadian Free Trade Agreement. Research shows that even just a tiny 5% increase in trade costs would trigger a $20 billion annual hit to their economy. And remember, that's before you even calculate the cost of building a military, launching a new currency, or dealing with major corporate capital flight.
Next up, Section 3, the private credit squeeze. We really need to talk about the hot new thing on Wall Street that is suddenly showing some very deep systemic cracks. Private credit is essentially shadow banking because these non-bank institutions lend money directly to private businesses outside of highly regulated banking environments. There's practically zero public market price discovery. Right now, we're seeing rapid write-offs where loans previously valued at 100 cents on the dollar are plummeting to 20 cents or even zero almost overnight. And as panic naturally sets in, retail investors who bought into these funds are finding themselves completely trapped behind gated, restricted withdrawals. When we pull default estimates from the major institutions, a pretty clear picture emerges. Now, analysts generally agree this isn't an exact repeat of 2008 because there's lower direct bank exposure, but the elevated risks are incredibly real. Morgan Stanley is looking at 4.5% to 8%, but Fitch is seeing defaults over 9.2%. UBS is even projecting up to 15% in a worst-case scenario. So the pain for retail funds rushing to the exits right now is very, very palpable. On to Section 4, the SpaceX IPO and buying hype. Let's talk about the most highly anticipated institutional to retail crossover event of the year. You really have to appreciate the sheer absurdity of reading actual science fiction mission statements inside a formal SEC regulatory filing. The quote, "to understand the true nature of the universe and to extend the light of consciousness to the stars," literally sits in a document designed to help investors assess financial risk. It's completely detached from the company's actual operating losses. Honestly, it's a masterclass in selling a grand vision rather than a traditional balance sheet.
And the price-to-sales ratios really highlight this massive market disconnect. Highly profitable AI giants like Alphabet and Meta currently trade at a multiple of around 10x. Meanwhile, SpaceX is hitting the public market at an eye-watering 90x multiple. They're primarily pitching their enterprise AI potential, specifically their Grok models, rather than just the rocketry business. And crucially, they are heavily targeting retail investors, reserving a record-breaking 30% of shares just for individuals. Make no mistake, this valuation is priced for absolute perfection.
Moving to Section 5, Gamifying Finance and Prediction Markets.
Let's dissect the explosive rise of these prediction markets and the social media gurus pushing them onto younger audiences. Underneath their slick, sophisticated interfaces, these platforms are essentially unregulated binary options masquerading as a data-gathering public good. They actively use federal loopholes to bypass state gambling laws, allowing users to bet on everything from political election outcomes to celebrity breakups.
And despite platform CEOs heavily lobbying lawmakers with claims that these markets are critical economic and political forecasting tools, the raw data tells a vastly different story. Just look at the volume breakdown for Kalshi. Almost 80% of their volume is simply traditional sports betting. Another 14% is crypto. The whole wisdom of the crowd argument gets pretty thin when you realize the crowd is mostly just wagering on basketball games.
Social media is totally flooded with wild claims right now. Influencers tell you that you can turn your little tax return into $50,000 just by copy trading or predicting the news. But behind the lavish lifestyles and those lucrative influencer referral codes, the mathematical reality is that this is a negative-sum game. The median retail user actually has a negative 8% return. Ultimately, the house fees, the high-speed institutional arbitrage bots, and the insiders take virtually all the profits.
Finally, Section 6. Takeaways for retail investors.
Let's cut through the noise. Here's your core defense strategy for navigating this modern landscape. Number 1. Always demand hard data over a captivating narrative. Number 2. Identify illiquidity risks. You have to understand that private credit and infrastructure funds can easily lock your money up for years at a time. And number 3. Beware the exit liquidity trap. Never buy into heavily hyped speculative tech IPOs or opaque shadow funds just because they're trending on social media. Too often, insiders are just using that retail hype to cash out their own shares at the top.
So I'll leave you with this final provocative thought to chew on today. As the allure of this giant financial casino grows, and as these apps make it easier than ever before to risk your hard-earned capital on a total whim, you really have to ask yourself, are you investing in fundamental reality, or are you literally just providing exit liquidity for someone else's hype? Make sure you know exactly what game you're actually playing. Thanks for joining me on this explainer. Keep asking the hard questions, and I will catch you in the next one.